All right, good. All right, good deal. Welcome everyone. Okay, welcome to the Retirement Scholarship Strategy. I'm excited to go over this information with you. I'm going to bust through a lot of this information, and then we're going to leave time for some Q&A at the end. So the whole topic here is how to send any student to any school of their choice and get all of your money back. I know that's a big promise. I've got some case studies. I've got some examples. I've got details. We're going to dive into it. But you can literally send any student to any school and get all of your money back without scholarships or financial aid. Now, of course, that never hurts if you can get some scholarships and financial aid, but I'm going to show you how to get your money back without scholarships and financial aid. So during this presentation, you will learn why you shouldn't pay for college with a 529 account, savings account, or your retirement, or even whole life insurance, or your monthly cash flow. I'm going to show you a better way to do it, and why you shouldn't use private college loans or home equity loans to pay for college either. And I'm going to show you how to use the retirement scholarship strategy to pay for college, again, for any student, any school in the country, and get all of your money back during retirement. That means public schools, private schools, community college, trade schools, whatever the case may be. Top tier Ivy League schools at 90 grand a year a pop. It doesn't matter. This applies for all schools and any student. Okay, so who will this work for? This strategy is for those with younger students who need a college savings plan, but I'm guessing most of you already have a high school student. So if you have a high school student, that is where most of our clients come from. This is designed for those of you who have even a senior in high school or even a freshman in college for that matter, and you need to figure out the best way to pay for college. Now, those of you who have no college savings, or those of you who have enough money saved for college, it will apply in both of those scenarios. So virtually any college funding budget. This is just a smarter way to pay for college. So if you're going to help your kids pay for half of college, then this is a great way to pay for that half. This will, fit anybody's budget. All right. Now, if you don't know me, I know I've been on here before, but for those of you who haven't been on one of my workshops before, my name is Lance Morgan. I have 5 lovely college-bound students, 2 of which are already in college. My 2 oldest girls are already in college. In fact, my oldest daughter just got married on Saturday, making me feel very old. But I've got 2 middle schoolers, and the little guy is still in elementary school. So I'm going to be doing this a very long time. So I am in the thick of it with all of you as well. I wrote a book called The Retirement Scholarship Strategy. It was a big deal back in 2018. It's maybe a little bit dated now. So the content today is going to be more cutting edge, more up to date. And so you're not necessarily going to need to go out and get the book or anything like that. We're going to cover all the good stuff in this particular workshop. I'm also working with Kevin Harrington to help spread the word. He was one of the original sharks from Shark Tank. He is helping us to promote this unique strategy as a way of paying for college, because he understands how important it is to be able to help families with such a huge need. Everyone knows that the cost of college has skyrocketed, and he understands that as well. And he fully supports the strategy that I'm about to share with you. We went out, met with him, did an interview. It was on national television. We even have a full page ad in Forbes magazine this month. If you subscribe to Forbes, you may have seen that. And of course, we've done a lot of social media advertising as well. Oops, we don't need to necessarily watch that. Okay, so one of my favorite quotes is, if what you thought to be true turned out not to be true, when would you want to know? So if what you thought to be true about paying for college turned out not to be true, when would you want to know? And of course, hopefully the answer is now, because we are going to dive right into it. But this is going to require a new mindset, because new mindset equals new results. A lot of what I'm going to tell you might be different than what you have heard in the past. So I encourage you to stay open-minded and just basically look at this. Just look at this for what it is. And this is the retirement scholarship strategy. Again, how to send any student to any school of their choice and get all of your money back without scholarships or financial aid. This is what we call secret number 3. We talk about 4 secrets. Secret number 1 is how to maximize the free money, which is Crystal and Corey. They specialize in helping you maximize that free money from the schools. Secret number 2, I wish I had more time to talk about, but secret number 2 is all about maximizing the college loan strategies. If you don't know what an income-driven repayment plan is that the government offers, you may want to research that a little bit. And we have some trainings we can send you on that. But that could be a huge savings. And then we get to secret number 3, which is how to get a full college funding refund. And then secret number 4 is how to increase your retirement income to make up for the cost of college. So we call that retirement restoration from college funding, how to restore your retirement from helping your kids pay for college. But today, I only have time to dive into secret number 3, which is how to get a full college funding refund using this retirement scholarship strategy. We're going to break this down into 3 sections: the concept, kind of a high level overview, the actual specifics, the companies, the products. I'm not going to hold anything back. You can ask me any questions. Okay. I'm not going to just tease you with information and then try to sell you something. There's no sales pitch on this workshop or on this presentation. I'm going to teach you exactly how to do this. We're going to dive into the details of it, and then I'm going to show you some case studies. Specifically, I'm going to show you a senior in high school case study so you can see exactly how this would apply to you and your situation. All right. So again, let's talk about the concept. Here's the big secret. The big secret is everyone finances college. Now, you may disagree with me. You may say that you've been saving your whole life since your kids were born, and you now have the ability to pay cash for college. But if you pay cash for college, if you have a 529 account, if you have savings, or if you have enough cash flow to pay cash for college, you're still financing college because you either pay interest on loans or you give up the interest you could have earned by paying cash. I had a client once say, "Why don't you like 529 accounts? Mine's been earning 8%. And I said, "Wow, that's unfortunate." He said, "Well, what do you mean? 8% is a great return." And I said, "Yeah, it's a great return, but now you have to spend that on college. So you're losing 8% interest on that money for the rest of your life. That money is no longer compounding interest. It's the opportunity cost of now 8%. So the cost of college is 8% on that money. All right. That is what we would call the opportunity cost. So there's the cost, and then there is the opportunity cost. Okay. Let me give you an example. Let's look at some specific numbers. Let's say that I have, let me go over here to this scenario here. Let's say that I am going to pay $27,000 a year for college. If I'm going to pay $27,000 a year for college and I just write the check, if I just pay cash, if I drain my savings, okay, then if that could have earned 6% interest towards my retirement, in other words, if I could have saved $27,000 a year towards my retirement instead of paying for college, then all of this growth, this column right here, all of this growth is what we would call the opportunity cost. All right. So that is the interest that you're not going to earn because you're going to pay cash for college. So that is what we would call the cash. So let me ask you this question. What if you could borrow money for less than you could earn on your savings? And what if you weren't required to make loan payments? So I'm curious, go ahead and put it in the chat just to make sure you're with me here. What if you could earn 6 to 8% on your savings? And what if you could borrow the money at 5% to pay for college? Would you rather pay cash for college, or would you rather borrow the money? What do you think? Just out of curiosity. And here's the kicker. What if you weren't required to make loan payments on those loans? Imagine being able to take out a home equity line of credit and just draw on the home equity line of credit to pay for college and not have to make a loan payment on that home equity line of credit. Would you rather borrow the money, or would you rather pay cash? What do you think? Okay. And I know we might have a little bit of a lag time there. Can they Oh, there we go. Chat box is working. Okay, good. Borrow. Okay, here they come. All right, there they are. Now they're coming in. All right, borrow, borrow, borrow. Looks like the consensus is to borrow. All right, perfect. All right, so now let's go ahead. You can keep putting your chat in if you want. Okay, now let's go. Hold on just a second. Be back over here. There we go. Okay, so what's really unique about this concept is the idea of not having to make loan payments. Okay, so imagine if you had the choice to either put your money each month. So every month you only earn a certain amount of money, right? So imagine being able to either put your money towards a loan payment costing you 5%, or put your money towards compounding interest at 6 to 8%. You would rather put your money towards compounding interest if you had the choice, right? So if you had an optional loan payment, if you didn't have to make a loan payment, and you could put your money towards compounding interest at 6 to 8%, that would make the most sense, wouldn't it? And that is the concept. If we spend our money on college, it's like killing the goose that lays the golden egg. We are interrupting that compounding interest. That's what I call the old way of paying for college. The old way of paying for college is that you save all this money from when your kids are born, or maybe you're saving for next semester. You might have no money saved for college and you're just saving for the next payment. But either way, you're saving and then you're spending. So in other words, you're not letting that money compound. You're interrupting that compounding interest. So here's the new way. The new way is that step one, you save and earn uninterrupted compounding interest for the rest of your life. I'm going to show you how you can earn 6 to 8%. Okay, in a safe, investment scenario. Okay. Then step two is you use that savings as collateral to secure a loan with an optional loan payment to pay for college or to pay back your loan. So if you're earning 6%, let's just say even 6%, and then we can borrow the money at 5%, it would look something like this. Let me give you a visual. Okay. So we take, hold on. I want this one here. Okay, so we save our money and then we use that savings as collateral. Okay, we use that savings as collateral to borrow the money to pay for college. Now, how many of you have a senior in high school? All right, how many of you have a senior in high school? Go ahead and put it in the chat box. Okay. A senior in high school. I do. Okay, we got one. Okay, yep. Okay, I do. Okay, all right. So we've got a lot of you that have a senior in high school, and I mean a senior obviously coming up right now. I know hopefully you're still in summer. We've got a little bit left of summer here. We start soon. But you might need to use traditional college loans first. If you don't have something like this in place, you might need to use the traditional college loans to first pay for college, and then we can use this plan to pay back those college loans with. Okay, so we could take out our college loans and we could just get started. We could take out our college loans and we could pay for college with college loans, traditional college loans, and then we could start saving into this plan, and then we could use that savings as collateral after graduation to start paying back those loans. So we keep borrowing and we keep paying down those loans. That's what it would look like if you had a senior in high school. Now I'm going to show you exactly how to do this with a case study coming up in a little bit. I'm going to show you a case study. All right. Okay. So that was the concept. Now let's dive into the products. How are we going to do this? First of all, we're going to need 3 components. We need uninterrupted compounding interest. So we need to have a savings vehicle that can grow the rest of our lives. we need to be able to borrow the loans at a lower rate. Okay. And then we need optional loan payments. And then, of course, it would be really nice if we had all these additional benefits as well. But let's just focus, for the sake of time, let's just focus on these three components. So how about your 529 accounts? Could you use your 529 accounts as collateral and borrow the money at a lower interest rate than what you're earning on your 529 accounts? No, right? You can't. You have to spend the money, which is therefore going to interrupt the compounding interest, right? Plus, what if it's bad timing? What if the market is down when you're trying to take the money to pay for college? Now you've just cut your losses instead of letting that money come back. So that's also something to consider when it comes to using the 529 accounts. How about the banks? Of course not. Since when have you ever been able to borrow the money from a bank at a lower interest rate than what you could earn on your savings account? Very rarely, if that's ever happened, right? How about 401k loans? When you take out a loan from a 401k, are you able to borrow the money? No. Okay. You're not going to be able to borrow the money from, it's not like your employer. It's not like your employer is going to loan you the money using your money as collateral, right? You're interrupting the compounding interest. Corey, you said my internet was dragging a little bit. Is it still work? Is it working? Can you hear me?
Yeah, you're fine.
We're fine. Okay, we're good. Okay, cool. All right. How about a brokerage account where you use your stock portfolio as collateral? Yes, it gives you a couple of the options, but not the optional loan payments. All right. So you could use your Amazon stock as collateral if you wanted to and borrow against it, but obviously there's a lot of things to consider as far as that goes. It doesn't exactly work like we're talking about. How about real estate? Again, what if you could take out a home equity line of credit and draw from that home equity line of credit without having to make a loan payment? Wouldn't that be cool? Unfortunately, that's not the case. Okay. How about whole life insurance? Believe it or not, you can use your whole life insurance cash value. In other words, if you're familiar with whole life insurance, there's a portion of it that has this savings component. You can use the savings component of whole life as collateral, and you can borrow the money from the insurance company without a loan payment. But you are not able to borrow the money at a lower rate. Okay. Your whole life insurance is only going to earn 4 to 5%, and they're going to charge you 6 to 8% on the loans. So it's not exactly what I'm talking about. It's not going to work. The other problem is, if not done correctly, it can be very, very, very expensive because of the high cost of the insurance. Now, how about the index universal life insurance product? If you haven't heard of this product can average a 6 to 8% return. It's actually guaranteed to never lose any money. And you can borrow the money at a guaranteed 5% return, depending on which insurance company you choose. And they guarantee you that you don't have to make a loan payment. However, if you don't do it correctly, it's not going to be low in fees. The fees are going to be very high because of the cost of the insurance. Here's an example. Okay. You can see that green line from a total charges standpoint. You can see that by default, this is very, very expensive. That's why it traditionally wouldn't work. However, the high fees means high commissions, and there is a way to keep the fees low. And this is what we call the secrets of the wealthy, how the billionaires, the banks, and the large corporations use life insurance differently. You can go to bankdirector.com and you can learn a little bit about how the banks are using life insurance. The banks use life insurance different than your traditional life insurance contract. by having what we call high cash value, low insurance. So if the fees are tied to the insurance, then the secret is to have low insurance. Okay, the cost would therefore be low compared to other insurance products. Tony Robbins actually talks about it in this book as well, in Money Master the Game, chapter 5.5. He talks about how the wealthy are using, how they're using life insurance in a similar way as the banks. And it all grows tax-free, and you have access to this money tax-free as well. So there's huge tax advantages. But as he says in the book here, he talks about how the billionaires are not even the ones buying the most. It's the banks and the large corporations, from Walmart to Wells Fargo. As an example, Wells Fargo had $18.7 billion of cash value back in 2014. The secret is low insurance and high cash value. Now look at the fees. If you do it correctly, it can actually be cheaper than a 529 account. It can be cheaper than an IRA or a taxable brokerage account at a 1% fee. So it could be less than 1% in fees if done correctly. Okay. So again, if done correctly, it checks all the boxes. Okay. So caution, not all life insurance earns 6 to 8%. And not all insurance companies offer 5% fixed loans. So your financial advisor may tell you not to do it because they may think the fees are really high. I know this because I used to be a traditional fiduciary that did assets under management. I used to sell a lot of 529 accounts. I used to set up 401k plans. And I used to tell everybody, don't use life insurance because it's too expensive. But I didn't understand that there was a way to actually make it less expensive. In fact, even less expensive than a lot of the other products. Insurance agents will also try to sell you too much life insurance. Again, the secret is that you need the smallest amount of insurance, but the insurance agents get paid commissions on the insurance amount. So they want to sell you the most insurance that they can sell you. You want to buy the least amount of insurance in order for this to work. So there is a wrong way and a right way to do it. Now, let me give you some examples. Let's pull up some actual numbers here. Where's my right here? Okay. Let's look at this one, for example. Okay, I'm going to show you the wrong way, and I'm going to show you why most people would tell you that this wouldn't work. Okay, if you look at just a simple $10,000 a year for 10 years, so $10,000 a year for 10 years, you're looking at about 36 to 38, 39, 40% in fees. And it continues to get more and more expensive over time because of this column right here, the actual life insurance amount. So if you're not familiar with permanent life insurance, there's an insurance component, and then there's this cash value component. So there's this savings account, and then there's the insurance component. If you die, you get the insurance and the cash value. But while you're alive, you only get what we call the available cash value, is how much you could get while you're alive. Okay. Now, what happens when you get older to the cost of the insurance? If you're paying for $290,000 of life insurance, and you're in your 80s or your 90s, look at how expensive it is compared to the interest that you're earning. I mean, how many of you would want to buy a product that has $467,000 of fees and only $367,000 of interest? Not that exciting, is it? Okay. Now, the right way, here's the right way to do it. The right way to do it, and this is what the billionaires and the banks and the large corporations are doing, is first of all, they're starting with less insurance. Second, they are reducing the insurance. That's the secret. That's the key. That's what a lot of people don't know that you can do. By reducing the insurance, look at what it does to the fees. Now, yes, the fees are still high in the beginning. So the fees start out high, but they're a lot less than the last example. But over time, look at what happens. The fees are now only $65,000, and your interest is over $1 million. That's a huge difference than the other example. And both of these examples are the same product with the same rate of return, the same client, the same $10,000 a year for 10 years. It's just designed differently. Okay. And this is the money that you can use to borrow from to pay for college. All right. Hopefully that makes sense. Now, can we really earn a 6% return on this product? Well, let me show you a case study of a client that's been around now for about 15 years. Move my windows. Okay, so here's a client that has been around since 2007. Remember, this product is guaranteed to never lose. So you'll see that for the first couple of years, they got zeros. And then they got an 18% return. And we were quoting almost 6% back then. We're now quoting 6%. In the numbers that I just showed you, they were at 6%. Okay. So we were quoting about 5.95 back then. You can see that in the first 2 years, they were a little behind schedule than what we quoted. And then after the third year, they were then ahead of schedule after that. Okay. Now, five out of the 15 years, they got zeros, because the way this product works is that you're guaranteed to never lose on the downside, but you can still get these double-digit returns on the upside, is how this product works. So if your average is 6% and you're guaranteed to be able to borrow the money at 5%, that's where you have that 1% positive spread. Okay. All right. I see some comments in the chat. Keep putting your questions in the chat, and then we'll dive into those in just a minute. Okay, so we've talked about the specific companies and products. These are insurance companies. These are called Index Universal Life Insurance, or IULs for short. Okay, IULs are what we're talking about here. Okay. All right, now let's go ahead and dive into some case studies. But before we do that, well, actually, no, I'm going to jump into these case studies first. Okay, so again, some of you have a senior in high school and you don't have one of these plans. So how will it work if you have a senior in high school? Well, you're going to need to take out loans to pay for college, unless you already have a lot of money saved. If you already have a lot of money saved, we can move that money into the life insurance over 5 years is the fastest we could do it. But if you don't have a lot of money saved, you're going to need to take out loans to pay for college. Let's just say that your future loan payments are $19,000 a year after your student graduates. So after your student graduates, if you take out the loans to pay for college, let's just say that your loan payment is $19,000 a year. Now, It doesn't matter if you're taking out Parent Plus loans. It doesn't matter if you're taking out private loans. I would strongly recommend talking to us before you take out any loans, because there's a huge savings opportunity there. But even if your loans that you're borrowing are 8%, okay, let's go back over here to this visual. Okay, even if your loans are 8% over here, and even if we're only borrowing money from the insurance company at 5% and we're only earning 6% on our life insurance vehicle, hold on, we go, boom, there we go. So if our life insurance is earning 6%, and we're able to borrow the money at 5%, but remember, we don't have to make any loan payments, okay? So these are compounding interest. One is compounding interest at 6, one is compounding interest at 5. This one are traditional college loans. Okay, our college loans are getting paid off. So the loan is decreasing. The interest is decreasing. That's the difference between compounding interest and a simple interest or a decreasing interest. Let me show you. Let me show you the numbers another way. Let's go over here and let's take this into consideration. Let's say that we have a $100,000 loan. Let's say that we take out a Parent Plus loan from the federal government to pay for college at 8% interest. That's higher than we might earn on the IUL, on the life insurance, right? But we're going to pay that off with the life insurance loan. So the interest, if you look at this interest, your interest is actually going down every year that you're paying that loan off. Okay. Hope that makes sense. Please ask questions. All right. So here we take out these loans from the insurance company to pay back our college loans. Now, here's the cool part. Just think about this like taking out a bunch of home equity loans, or think of it like having a home equity line of credit and you're just drawing on that home equity line of credit every month or every year, okay? Look at the compounding interest. It doesn't interrupt the compounding interest. However, now you have these loans, and if you're not making loan payments on these insurance loans, they are also compounding interest. So now you have the loan interest that is growing. You have your loan balance that is growing. But as long as your account is growing by at least 1% faster, then you have what we call a positive spread or a delta or arbitrage, whatever word you want to use, okay? And eventually, that 1% will give you a full college funding refund, a full refund on the amount of money that you originally contributed to this plan. Now, you don't have to put in $19,000 a year for 10 years. You could do 5 years. You could do 15 years. You could do $500 a month. It's whatever you can afford to help your kids pay for college. Okay? Whatever you can afford to help your kids pay for college. Now, let's continue and then we'll come back with some questions here. All right. Okay, so pros and cons. No college funding plan is perfect. All right. These are all the benefits. Okay. 6 to 8% average return, fixed at 5% for the loans, optional loan payments, all the tax advantages, the low fees, guaranteed to never lose. There's a lot of benefits. Okay. Now, here are 5 considerations. It requires a little bit more discipline and consistency versus saving money into a 529 account whenever you have some extra birthday money from the kids that you want to put in their 529 account. This requires a little bit more consistency to get this up and running. Okay. Limited access in the early years. In the early years, you don't have full access to all your money. So you need to use the college loans to pay for college if you don't have one of these plans in place. So for those of you who have a senior in high school, you're not going to be able to use this to pay for college next year. You're going to need to use the college loans to pay for college, and then you can use this to pay back the college loans later. It is life insurance, so you must qualify. If you have health issues, then hopefully you have a spouse that could qualify, or you could also look at putting this on the kids, but there are some considerations there as well. The U.S. might file bankruptcy, and you may not earn 6 to 8%. So let's go over here and look at the kind of worst case scenario. If the U.S. files bankruptcy and we don't think our money is going to keep growing, we don't want our loan to keep growing, so we will just take our money and pay off the loan. You are never in debt with this strategy. You are never in debt because you can always pay off the insurance company. Okay, going back over here to this visual right here. Oops, again, clicked on the wrong button right here. Okay, if you have your cash value as collateral, we can always take this money and pay off this money. Okay, you're never in debt. If you want to sell it, if you want to pay off your mortgage, you could pay off your mortgage tomorrow if you want to. Just sell your house, right? If you sell your house, you could pay off your mortgage. I mean, you would be homeless, but you would be out of debt because you could sell your house and pay off your mortgage. So your mortgage is being collateralized. In other words, you're using your house as collateral for that mortgage. It's the same thing with this. We're using our cash value as collateral to borrow against it. Same concept. Okay. All right. Okie dokie. And last but not least, this requires a completely different mindset, a completely different way of looking at paying for college. This is not something that most people have heard about. I know I had several years in the financial industry before I heard about this. And when I heard about this as a father of 5 kids, I thought this was the greatest thing since sliced bread. So I was so excited to go out and tell everybody about it. And of course, I've made a career out of it doing this. Now, I think it's awesome, and I think it works great. But a lot of people just get stuck in that traditional mindset of I need to save and then just pay cash for college, or I need to just take out loans and pay them back. But if you can wrap your head around these unique concepts, it works great. Gives you new results. Okay, I want to leave you with one thought and then we'll jump into Q&A. All right. If I asked you to jump out of an airplane without a parachute for $100,000, would you do it? In fact, my daughter actually just got back from Moab, Utah, where she just jumped out of an airplane. Luckily, she did have a parachute. But would you jump out of an airplane without a parachute for $100,000? Probably not, right? But what if it was on the ground and you had these little bouncy things to jump on? Now, obviously, it changes things, right? Now, I don't want you to miss out on a $100,000 opportunity, or I don't want you to miss out on free college for your kids by getting all your money back, because you might jump to some conclusions and you might not have all the facts. So I want to make sure we leave enough time to go over Q&A, because I want to be able to make sure we answer all your questions. And then we're also offering a free consultation where we can run all these numbers for you. So if you want one of these reports, with your numbers to see what your numbers would look like, then there should be a link in the chat that you can use to book an appointment with us, and we will show you your own specific numbers. Does that sound good? All right. Should I just look in the chat and go through the questions, or what do you want to do from here?
I think that we had some chit chat in there going earlier, but one in here is, I'm a single mom with no home. This doesn't seem viable for me.
Okay. So as a single mom, if your goal is to take a part of your income or a part of your savings or a part of your retirement or any money at all to help your kids pay for college, then you would just use that money through this particular strategy to help your kids pay for college. If you're not able to help your kids pay for any of college, right? If you have no financial means to help your kids pay for college at all, then this may be something you could teach your kids. Like, let's say that your kids are going to work a summer job and they're going to save up some money during the summer and they're going to pay for their own college. Well, then your kids could do something like this. They could take the money that they earn during the summer and they could use this strategy, and they could take out the traditional loans to pay for college. So that's an option too, right? My wife is the oldest of 6 kids, and her parents couldn't help them at all. They grew up very poor and the family couldn't help. So they had to pay for their own college. There's no shame in that. So any other major questions that jumped out at you?
How does one afford to put up $10,000 a year for 10 years?
Well, again, same question, same comment, whatever it is that you plan on helping your kids with. You know, some families are helping their kids with some of it, none of it, all of it. Totally depends on you. This is just a better way to pay for college. This isn't how to get college for free. It's a better way to pay for college and get your money back.
What if you already have $200,000 in a 529 with a child who is a senior?
Excellent question. So if you move that money into something like this, then there would be a 10% penalty on the gains, not on all of the money, just on the gains. And then your gains would also be taxed. So you have to do the math. You have to call up the place that has the 529 money, and you have to ask them how much you have in gains. So let's say that you figure out that you are going to have a $10,000 penalty and taxes. Okay. Well, you're only going to be able to move the money over 5 years. We can't move it all at once. So we have to spread it out over 5 years. So you're basically going to pay a fifth of the taxes and penalty each year. So whatever your taxes and penalties are, you would basically divide that up over 5 years. However, that means that for 4 of the 5 years, your money is going to keep growing. And then 3 of the years, it's going to keep growing. So as you're moving the money over 5 years, your money is going to still compound interest where it's at, which could help you recoup maybe some of that expense. However, I also want to encourage you to calculate the opportunity cost of paying cash for college. So if you take that 529 money and you pay cash for college, there is also a cost to that. Okay, there's an opportunity cost because that money is no longer compounding interest. Hopefully that answers that.
What is the difference between index universal life and variable universal life?
So a variable universal life policy, the money is actually in the stock market, so it can go up and down. So in this particular product, they're only taking the interest and putting it towards the stock market. The principal is always safe. And so it's guaranteed to never lose, but you can still get double-digit returns. Whereas a variable product is more like a mutual fund. and it can go up and down. So you could lose money.
So, and then somebody says, to clarify, I have a 529 and an 11th grader. It's a good idea to move the funds over to an IUL ?
We can definitely run the numbers for you. We can do the math. All right. We can do the math and you can see. I mean, I always tell people, let the numbers speak for themselves, right? So we could plug your numbers into our software. We could see what your opportunity cost is. We could see what it would look like if you paid cash for college, and we could show you what it would look like if you moved the money over into here. And my guess is, if you look at these numbers right here, down here, if you look at these numbers, my guess is, since I've ran these numbers like 1,000 times, that you're going to make up for those penalties long-term.
And we have Dan popped in. He's made his appearance. Dan is our other partner here. He's the one that runs the funding meetings and works directly with Lance on all of these numbers. So I just wanted to have you guys meet and greet with all of us on our wonderful college planning team.
His face and say hello.
You just made me smile, Crystal and Corey. And I've been working with Lance for quite a while. The strategy is absolutely perfect for paying for college and other capital expenditures that you have in your life. I just say, let's just run your numbers and just make sure that it's the right fit for you.
Yeah.
Can't wait to meet y'all.
That's a good point. I just had a wedding. And
yeah,
I paid for the wedding using the same strategy. You can use this for weddings. You can use it for college. You can use it for retirement. You can use it for anything you want.
Yes, sir. I've had a lot of people I mean, I've had a lot of people even plan it for like church missions and everything in between, buying cars, remodeling houses. I mean, imagine becoming your own banker, if you will.
Yeah. Yep.
We got a couple more. My VUL is set not to lose money, but the growth is capped at a certain percent, i.e. 12%.
Okay, that sounds like an IUL to me if it's set to not lose money, but it may be some sort of an investment option inside of the VUL. So you're going to want to look at the average return, and you're going to want to call up your insurance company and ask them if they have this type of a loan. So you want to make sure that you could borrow the money, like I'm explaining here, at a lower interest rate than what you're earning on that VUL. And then if you can, then it'll work. So if you feel confident that your VUL can average a better rate of return than the loan cost, then it will work. But you just want to double check some of that. And we are happy when we meet with you, we are happy to look at that with you, maybe even do a 3-way call with your insurance company to ask the right questions. So,
when is the best time to put money in an IUL? Like how many years prior to college?
it's like asking, when is the best time to plant that oak tree in your backyard?
Yesterday.
Yeah. But you can still do it even if
It's never
you're in college.
Right. Never too late.
90% of our clients have a senior in high school when they learn about this.
Yeah.
So don't feel like it's too late. I have lots of clients with kids already in college. I would say as long as you have at least 3 years left of college, then it works great.
Yeah.
And if you only have a couple years left of college, it will still work if you have the ability to fund it enough. So it kind of depends on your budget.
And we just have to run numbers.
Yeah, we'll just run the numbers and show you, see if you like it.
Yeah.
Is the gain tax-free?
Yes, the gains are tax-free, and you can access the money tax-free because it's a loan. So since you're borrowing the money, it's tax-free because you're borrowing the money. Loans are not taxed.
And then also follow up, I had my variable universal life for over 10 years and it had gained much already. Can I borrow against it instead?
You could, again, if you can borrow the money with the right loans, if you can get the right loans. Be careful, they might have variable loans. You might get this huge loan balance and it might be a variable loan. And then you might, in the future end up paying 10% on that loan someday. And if you're not paying that loan back and it's compounding, that could be very dangerous. So we want to make sure that it checks all the boxes, right? And if it does work, then great. If it doesn't work, since you've had it over 10 years, you can do what we call a 1035 exchange, and you can take the cash value and you can move it over into one of these plans without triggering any tax consequences.
I think that's a great point, Lance. It's kind of minimizing your risk if you look at the new kid on the block, as you say, with the IUL. Yeah. And that 1035 exchange allows you to do that. So let's, like I said, book the appointment. Let's talk about it, give you your options, and then you'll make the best decision.
Yeah, I used to have VULs on myself, my wife, and all my kids. I sold a ton of VULs back in the day. But yes, like Dan said, the IUL is kind of the new kid on the block because you can get double-digit returns without any losses. It's kind of the best of both worlds.
Is it too late if I'm ready to retire?
No. In fact, if you're ready to retire and you plan on using retirement funds to help pay for college, then there's another strategy that I don't have time to go into on this call, but there's another strategy. If you're past 59 and a half and you're planning on using some retirement money to help pay for college, then definitely book an appointment with us and let's run another scenario for you that we'll explain to you. That could be another option for you to look at, and you can kind of compare the two.
And just so everybody knows, I'm hoping everybody can see it. I've put the link in the chat box, so you'll see it says Dan Funding Meeting link, and you are welcome to find a time then that works for you guys in order to book that consult and have these more in-depth conversations for you one-on-one. And I will also be posting it, and you will get an email and as well as the she's all never mind, as well as it will be in our Facebook group. So you guys are welcome to find it and rewatch, right? Share with friends, share with family, share with a loved one who couldn't be here with you, because it is amazing what we have the ability to do in order to pay for college, not cry about it, and still have money left over for retirement.
Not crying about it.
We still might cry.
It helps.
Just kidding.
I registered
Yes.
mine for fall term today. It didn't hurt as much because I knew that there was this. So
do you recommend to open an IUL and move an amount from a 529, which we kind of talked about earlier?
I mean, the short answer is yes, but run the numbers. Just let us run the numbers and show you. And if you don't like the numbers, then you can use the 529 to pay for college. Or at least if you don't have enough money in the 529 account, then you could use this for whatever the shortfall is, right? So maybe you've got enough money saved for 1 year's college and you still are 3 years short. Well, then use this for the other 3 years if you don't like, the numbers. And if you really just have heartburn, over taking that penalty on the gains. But there's also other options that they're coming out with where you can move the money into a Roth IRA. There's ways that you can use that money to pay back on the college loan payments later. So there's some other things you can do with that 529 money without a penalty. If you have enough extra money to do this, to pay for college.
lots of options, right? We've made it work in so many different scenarios.
Mhm.
So that's why we love it.
Got it. You got it.
Well, we are happy to take
Crystal-
what?
Dan, and then we'll
Yeah, I was just gonna say, we're happy to take any final questions that you guys may have for Lance and the crew. We look forward to meeting, having you meet with Dan. And as other questions arise, you can always feel free to reach out to us. But we respect your time. And so we appreciate you being here with us tonight. And we look forward to seeing some of you in person.
Yep. It was fun. Thanks for having me
Thank
on.